So I'm excited today to host and moderate this panel on stablecoins and security tokens. We've got a distinguished panel of speakers that all bring in a different insight into how this works. I will be doing very short introductions because these people are very well known. You can look them up very, very quickly afterwards. Firstly, we have Patrick Hansen right at the end. So Patrick is, yeah, right on that. So Patrick's the Senior Director for EU Strategy and Policy at Circle, USDC, a global financial technology firm and the issuer of USDC and EURC. Circle helps global businesses harness digital currencies and power blockchain. And prior to that, Patrick was the Head of Strategy and Business Development at crypto wallet startup Unstoppable Finance. And he headed up blockchain policy at Bitkom, Europe's largest tech trade association. I did ask these to be a bit shorter, guys. So I'm gonna cut them down a little bit. I hope that's all right. Then we have, well, I'm just gonna go through the order that I have everyone written down in. We've got Dimitrios. Dimitrios is a senior fellow at the Wharton Business School at the Center of Digital Assets, the CEO of ValueVerse, and former European Parliament economist, and most interestingly, co-drafted titles 2 and 3 of the Markets in Crypto Asset Regulation in the EU and the DLT pilot regime. Thank you for joining us, Dimitri. I'll move on to Peter Goodrich. So Peter is a member of the Secretariat of the Financial Stability Board, where he leads the policy work on crypto assets and stablecoins, and previously was a lead supervisor at the Federal Reserve Board. Then we have Marco. Marco is a professor of finance at Imperial College Business School. Before this, he was at Harvard, where he founded the FinTech, Crypto, and Web3 Lab, and he holds a PhD from MIT. Beyond academia, he served on the advisory board at Coinbase Institute, consulted for companies like Ripple, and he currently serves as a board member at the Mina Foundation, a zero-knowledge blockchain. And lastly, we have Vineet. We placed him in the center because that's exactly where he likes to be. He's the CEO and managing director of Cypher Capital. They're a perennial investor in possibly every major crypto project of note today. And we are extremely delighted to have all of you here today for this discussion on stablecoins and security tokens. Now, before I pose the first question to the panel, I just thought I'd do a little bit of framing for the audience. When we were given this topic by the organizing team, they asked us to talk about stablecoins and security tokens, and that was about it, and left it to us to decide how we should do it. And when I looked at the backgrounds of these extraordinary speakers, it became very clear that this is going to be a very hardcore discussion on policy. So my opening question to you guys is, and be ready, how would you define a stablecoin? We'll start with Patrick.
Oh gosh, so I have the mic, I need to go first. It's a tricky one because, I mean, anyone can use the stablecoin, the name stablecoin for anything, right? And so what we always tend to say is that all stablecoins are not created equal. You could take a legalistic definition of a stablecoin, and that depends then on the jurisdiction. In the EU, for example, what we refer to as the classic fiat-backed stablecoin concept is legally defined as an e-money token. So there's a legalistic definition. You could take a more, I would say, pragmatic, principles-based decision. What we call oftentimes a payment stablecoin is something that is as close to cash or government obligations as possible. So that's something we often use. So whatever is backed by just, cash deposits and short-term government debt, for example, that we treat that as stablecoins, where this versus other constructs that are more, like I would say, creative in nature, we wouldn't define that as a stablecoin. So these are just a few angles. I don't know if anyone wants to add anything.
Dimitrios?
Don't look at me. Well, the definition of the stablecoin is what you see in MiCA. We are happy with that. We have 2 flavors of stablecoins in MiCA. The one is what Peter mentioned as e-money token. Tokens that the underlying asset is a fiat currency issued by a government. And we have another beast called asset reference token that is serving the purpose of the means of exchange. For some perverse reason, the the initial draft of the of MiCA does not want to associate a stablecoin with something we call store of value, and they say it's not a store of value, and because it is not, you will not be granted interest out of holding this. I cannot find an association between store of value and means of exchange in this level. It was a French invention in the project. I can say that if you go around in the market, I suspect that we have at least 50% of stable coins we see out there that are not covered by MiCA.
So for me, I'm not a regulator. It comes from the adoption side. I think stable coins can be decided on two key things. That is the geography that it is. For someone in Zimbabwe, a stable coin is different, and for someone in the US, a stable coin is different. So for someone in Zimbabwe, it is a coin that replicates the most favored currency globally. So it has to be something like USDT, because his own currency is depreciating 10,000% a day. And even in Lebanon, even in Argentina, Argentinian peso has gone down 95% in the last 10 years. But for someone in the US, it's not the same case. He already has the US dollar. For someone in the US, a stable coin is something that preserves his buying power. US dollar has lost close to 8% in the last 40 years. Technically, $1 million, you could get a house 5 years back. Today, you can get a toilet in that. So stable coin, yeah, it's true. In Dubai, you see that,
Absolutely
right?
true.
So a stable coin for someone in a developing country where the policies are not strong and the currency is depreciating is something that gives him the best economic stability, like in the US. But in a developed country, it's something that preserves his buying power.
So I think from the FSB's perspective, and we have recommendations on stablecoins, we take a more principles-based approach. So we just simply say any crypto asset that aims to maintain a stable value relative to either a specified asset, i.e. fiat currencies, a pool of assets, or a basket of other currencies. So we take a more principles-based approach. If you're making that promise to maintain a stable value, then you're a stablecoin.
Okay, so I'm the last one. It's sort of difficult to add anything here.
We believe in you.
Maybe I would sort of propose a framework that might be helpful to think about not only stable coins, but also CBDCs and other type of tokens here. So one way of thinking about this is that stable coins are some sort of private version of money, while, for instance, CBDC as well as fiat is a public version of money. And anybody can actually issue a stable coin. That's sort of what scares the regulator as well. I think most of the time, not everybody should buy those stable coins or use them as source of payment. But that's, I think, at the source of many of the conflicts between government-backed CBDC versus private version of money. Because think about this, we are in a situation which has not occurred for the last 200 years. Maybe the only one that I remember was in the US, when every single bank would issue some sort of private version of money, in the sense that every bank, Bank of Dallas would have banknotes that were different than the banknotes in New York, that were different from the banknotes in San Francisco. And each one of those, you can think about this as the old version of stable coins. Each one of those should have been pegged to $1. But then there was sort of a black market and how all of these things would exchange between each other. If you think about it as today, we are sort of worried about the same thing. USDC versus USDT versus any other sort of other stable coins that might come up. What are we worried about? We're worried about the collateralization. We're worried about the underlying risk. That's exactly the same thing that we're worried 200 years ago, people, when we were thinking, oh, maybe the central bank in Dallas is not as safe as the one in New York. So we are a little bit repeating history with some new challenges because of the technology. Maybe we're going to get into.
No, that's a really good point. And in fact, what strikes me as quite interesting is right now on this panel, we cover such a diverse range of perspective, right? We've got 2 regulators, we've got a leading advisor, we've got an investor, and we're looking at someone who's doing the issuance and the distribution of these coins. And so as you saw just from the preliminary answers, everybody's got a slightly different and very principled way of looking at it, either from purpose, either from regulation, from outcome and value, and certainly from risk. So I guess tying into what you just talked about, Mark, I'll go back to Patrick, and this is specifically for you, because we'd love to hear more about how Circle is looking at this kind of question about trust, right? At the end of the day, we trust our central banks, and we trust our governments in most places. And the question would then be, why should we trust Circle? And also, how is Circle bridging that gap between traditional financial systems and securities globally? Because if you get the traditional financial systems to come on board, retail follows relatively quickly because access becomes easier.
Yeah, so there's a bunch of aspects in there, but let me try and tackle a few of those. So, I mean, when it comes to trust, I think the key aspect here is how to create the best redeemability and liquidity around a stablecoin, because that's what ultimately assures then the one-to-one pack. And I think in that regard, what we do on the liquidity side is that we are trying to onboard with as many banking partners as possible, for example, around the world, so that we're also essentially linked to all the most important regional local payment regimes, so that if we have customers, for example, in one region, those can on and off board our stablecoin into fiat very quickly and very seamlessly, because we have banking partnerships with those local banks that have those local payment rates, as one example. So that's about the liquidity. We're also obviously partnering with a lot of those trading venues in order to create the best possible liquidity for all retail or institutional folks to tap in and out of that stablecoin. When it comes to redeemability, I think there's various aspects that I could lay out. There's a regulatory one where we have taken always a regulation first stance that has been exemplified, for example, in the EU recently, where we are the only and the first major global stablecoin issuer to be compliant with those new MiCA rules, for example. So I think the legal insurance, so the legal claim that folks have against us, that's a very important part about the redeemability. And then ultimately, it's also about the reserving setup, the transparency around it. I won't go too much into detail here, but anyone, anywhere, can have almost a real-time view about what actually backs USDC. There's a SEC-regulated fund of one that BlackRock manages for us, where most of the USDC reserve sits in. You can check the website of that fund online. You can see the single security that backs USDC up to the QSIP number, essentially. So there's almost perfect transparency. I don't know any other financial institution that is as transparent as that. If we think about banks, for example, who knows, what a bank, like what kind of loans the banks have on their balance sheet. So that's about, I would say, redeemability, liquidity. We're doing our part here. To your second question, very briefly, how we bridge crypto and traditional finance. I think there's a few angles here that I could touch on. There's the product-related angle, how to essentially make sure that all these counterparties are connected. We're doing that through, as mentioned, the integration of those banks and financial services providers with partnerships with MasterCard, Visa, all the big payment service providers, so that they can leverage our stablecoin when useful for them. So there's the product and business-related partnership side. And then the big one is, I would say, clarity on accounting, tax, regulation, compliance, etc., because that's the key missing piece of the puzzle for those major financial institutions. Because most of them, when they look at a stablecoin, and we discussed how difficult it is to define those, they look at it and say, but how should I treat that on my balance sheet? Like, what is it? Is it a crypto asset like Bitcoin, or is it just money as any other bank deposit? And so at least in some jurisdictions now, that clarity is getting better. I think we're getting there in the EU, for example. An e-money token essentially is not that much different. I know there's a lot of open questions here, but is considered to be deemed e-money. And so you could treat a stablecoin that is an e-money token in the EU as any other form of e-money in the EU on the balance sheet, like your balances on PayPal, for example, any other PayPal payment service provider. So that's I think a key driver. And in a couple of years, I personally think that in most important financial jurisdictions, we will have clarity on what that asset means from a tax accounting regulation perspective.
Thank you, Patrick. Very, very helpful, because it's interesting to learn the kind of big tent one of the leading players is trying to create in order to create that cross-industry integration. So I guess jumping off of that, Dimitrios, how do you see security tokens reshaping capital markets, and what are the key factors driving their adoption, given that you have major players like Circle going out of their way to link up with traditional financial services providers and kind of institutionalize themselves. So you talked earlier about how you've created a regulatory difference between the fiat tokens, the asset-backed tokens. What is the thinking on why this has been done and how it ultimately contributes to the regulatory oversight that needs to be done over these services?
First, it's very important to have this bridge between security tokens and stable coins, because if in theory an e-money token is a fund, you can settle a transaction on chain. And this is the famous last leg problem. And one of the major reasons that adoption of tokenization of financial instruments does not flow very, very well, because we don't have enough funds to settle transactions online. So the first determinant of the adoption of this is the infrastructure. We are talking about a financial value chain, placement, trading, clearing, and settlement. If we assume that we get the economics and we understand why the hell Siemens tokenized a bond of 200 million as if they couldn't find the liquidity elsewhere, and we understand where the profit comes and where the value comes from tokenization of financial instrument, and we tokenize everything, do we have the protocols in place in order to ensure finality without risks? Do we have the scalability of the protocols that can ensure 100,000 transactions per second? Are we sure that the interconnectedness between the different parts of this equation of the financial value chain will work in tandem in order to ensure that everything is going to work? So infrastructure is number one. Number two is getting the economics right. So what is the financial economics of this? When we have the adoption of a financial innovation, usually we're talking about, okay, it's a workshop, right? So we can be a little bit academic. Market completeness. So what is the actual function that will enable these network effects to create this economic shock and move from the traditional way we are doing business to another way? The other aspect is the information sensitivity. Smart assets. Everybody wants to have a smart asset. But an asset of somebody else's liability. Who wants to have a smart liability? Is there any regulator who wants to have smart liabilities in the supervised entities? So in the question, what is a stablecoin? It's a liability over a liability. It's a liability created by a central bank, followed by a liability on the form of token. So it's a dump asset. Why? Because it doesn't give informational benefits to the ones who hold it. And what is even better than an e-money token? A token denominated in gold, because gold is the liability of nobody. So information sensitivity is the second very important parameter. And the third crucial factor of adoption, obviously, is the organizational economics of the story. If the issuers of tokens, banks, base their business models on opacity, and all this is about transparency, how the hell you are going to adopt this? I see all these good colleagues who fight in these major banks, JP Morgan, BlackRock, etc., to promote these tokenized assets, and they are singing a completely different song compared to their bosses, who made money in a completely different way. So these are these three factors: certainty on the infrastructure, understanding of the financial economics, and organizational adoption before we move forward.
Thank you. So I guess building off of that, Vinit, tokenization of real-world assets has been one of the buzzwords since 2023. It seemed to be one of the few lights in the middle of the crypto winter as well. From your perspective, leading one of the biggest VC firms in this sector, and considering the amount of oversight that is now becoming mandatory for anybody trying to tokenize RWAs, how are you evaluating projects, evaluating startups? To what extent, if any, does their back-end ability to comply with these sorts of rules and regs play a factor? And how are you making a decision of where capital should be deployed?
So again, yeah, there's this whole theory about flavors in a bear market. You know, everyone said gaming, everyone said tokenization. Unfortunately, we at Cypher, we're one of the top 5 investors globally, according to Woo Blockchain. Don't look at flavors, but look at founders. You know, a great founder with a bad idea can still make great things, and a great idea with a bad founder can really screw it up. So what I want to say is, first, before going into what makes a critical thing, is we look at founders, how they will build this up. I have invested in a stablecoin project, which is building on Bitcoin. It's building a Bitcoin-based stablecoin. Post that, we look at, you know, in case of stablecoins and in case of real-world adoption, is how will you get users on board? Now, the biggest problem is that USDT and USDC are the market leaders. How will you see to it that that retailer down there will start taking USDT?
So why should they?
And why should they? And the biggest problem with a lot of founders right now is that everyone is landing up in New York and Dubai because money is there. It's like Eduardo Sarin landing up in New York while building Facebook. While the real founders need to land up in Africa, in Latin America, and build up over there in terms of adoption. And why is it that Zimbabwe still uses USD and not USDT? Because no founder is going there. So in our case, when we evaluate all of these things, we look at how the founder will build on it, how will he work with regulators. One of the key things that makes a successful company, and you can look at it in Apple, you can look at it in Microsoft, is not just the business model, but how well do you work with the local governments. And again, these startups have not been built. They've been focusing on raising capital, and they've been focusing on building ideas. So for
I'm
us,
trying to imagine the average Web3 founder talking about sitting across regulators' desks.
oh, they don't.
Yeah, the laughter is warranted.
So in fact, the speaker earlier mentioned, you know, there is a company, again, I'm not sure whether I'm allowed to talk names about tokens, but there's a company which raised $400 million in India and landed up in Dubai.
Yeah, no idea who that is. Go
Yeah,
on.
no idea who that is. What I'm trying to say is he could have sat there and talked to regulators as well. But again, founders have to focus on the business and build it up. So regulator comes at a later stage. You know, we have to send people to manage regulators, manage politicians, but that happens at a later stage. And I think for us, evaluating in real world assets and things like that, it's about how capable this founding team is. Everyone says that, you know, when you look at crypto as such, if you have a house, to take a loan, you need to go to a bank, and the bank will decide in 3 months whether he will give you a loan or not. Now imagine in Bitcoin, if you have $1 million Bitcoin, in 5 minutes you can get a 75% LTV. Now imagine your house lands up in on-chain, and you can get the same loan in 5 minutes. The whole world changes. But the problem here is not taking the house online. The point is, will Dubai Land Department agree to the title deed going online, and will it vet that it is at shape? Like, I don't need to go to the land department. Online transaction happens and it happens. So that's where regulators become important, and their vision on how this world will change is important.
So that's actually a really good segue then for Peter, because the vision that Vineet is espousing, as you would expect, very, very attractive. But the problem is, how do you ensure financial stability when unregulated players are putting houses online to raise mortgages or other such types of endeavors? What do you look at in terms of risk mitigation when creating policy and looking at projects that want to move things forward in a way where, let's be honest, a lot of traditional financial institutions have been stagnating?
Yeah, no, so I think for stablecoins in particular, when we think about kind of what are the systemic risks, I think as Marco was saying earlier, it's not that new. This is private money. We know what the risks are. We've dealt with it for a long time. There's a long history. So when you look at, for example, what the FSB has published, we point to a lot of existing cases of banks, of money market funds. The types of financial stability risks that we see, I would say there's 3 main kind of channels that we focus on. The first is a use case as a store of value. So if these start being widely used as a store of value, people's savings are denominated or stored in stablecoins. Any reduction in the value of a stablecoin can have a significant impact on people's savings, their wealth, their investment, and that can have, you know, if it's widely used, that can have a significant impact on financial markets. The second use case would be a means of payment, which has been discussed already. So if you're used as a means of payment, any disruption to that stablecoin being used as a means of payment can have a significant impact on economic activity, on the financial market functioning. So again, there's a huge systemic risk implication there. The third one is really related to, as stablecoins scale up, their interaction with the traditional financial system. For stablecoins, the classic example is, the reserve assets. Those have to be invested somewhere. They're, as was mentioned, either U.S. Treasuries, bank deposits, other financial assets. So if there's a disruption or, for example, a run on a stablecoin, they have to liquidate all those reserves. That's going to have an impact on financial markets. And certainly if it's a global stablecoin used around the world, that could be a lot of selling in a lot of different markets. So those are the three main kind of financial stability risks that we look at, that we thought about in devising our global regulatory framework for stablecoins. And it's really focused on ensuring that stability, making sure that stablecoin issuers have the right types of frameworks to back up that claim, so they have a strong reserve portfolio, it's high quality assets. I think we'd probably disagree that Bitcoin is a high quality asset for a stablecoin reserve. It should be things that are easily, maintain their value and are secure
Really?
assets.
Can we use that soundbite and take it to a lot of family offices?
But Bitcoin is anyway not a stable coin, it's a store of value. It's a
Well.
very different concept.
If I may entertain the audience, is gold a stable underlying asset, highly liquid, to accept for a stable coin?
So if it's a fiat reference stablecoin, I would say absolutely not. If you're referencing the US dollar or the euro, you should not be backing with something other than that. If you want to be a gold reference stablecoin and reference the price of gold, then of course. The thing you're referencing
The
should be
dollar
in
did
your
that
reserve.
for a long time until they didn't.
But it depends on what you're referencing, right? So if you're going to reference,
Gold,
exactly.
Not the derivatives of gold.
Mhm.
EBA proposes derivatives of gold are more stable than the gold itself.
But the irony of this comment is that, US dollar, which was backed by gold in 70s, took it off just to print more money. And now we are saying,
we're talking about going
we are
back.
saying, what is USDT backed by?
Well, now we're talking about making options. Sorry, Marco, to come to you, we've heard about integration from Patrick. We've heard about regulation. We've heard about opportunity. We've heard about risk. I'd love to hear from you about disruption, about the vision of what the mass introduction of stablecoins and security tokens, if realized in the way Vineet wants it to, what would that do in terms of disrupting, whether it's traditional financial ecosystems, or it's disrupting markets in general?
Okay, so maybe one way of thinking about this that goes back to one of the points earlier is think about where these get adopted. Do they get adopted in developing countries where the payment rails are already established, and so you are fighting against a tech stack that sort of in 90% of the case works? And for the retail investors, for the retail consumers, they don't actually appreciate much of the frictions that are actually there. The 2%, 3% that they pay on the credit card, it's something that we get accustomed with. And they and we don't realize that we are actually giving up a lot of money. But in countries, in developing countries, where the transaction fees are significantly higher, just because the payment rails are not there, the disruption might be very different. Let me bring a couple of cases. Depending, even within the different developing countries, the adoption of stable coins, and I think in second wave, the adoption of tokenized assets might have very different implications. If I think about Nigeria, for instance, is using stable coins sort of as a way of accessing tokenized assets that are US backed. So if you think about many countries around the world, and so the investors in those countries don't really have access to assets that are denominated in different currencies. Having access to tokenized assets that are denominated in dollars is sort of a big deal. In Venezuela, they are fighting against hyperinflation, and we are seeing a mass adoption of stablecoins as a way of hedging against that inflation. In other countries that are much more developed, like Brazil has both the payment rails that we are used to, like the credit cards, but they also have PIX, which is another government-backed payment rail, which has been adopted basically by 80% of the population in 6 months. In a country like that, you would think that actually stablecoins don't really find a good fit. Why? Because at the end of the day, you already have something that has perfect trust because of the government, has already been adopted, has significantly lower barriers to entry. And so why should they use stablecoins in the first place? So that's one place where you may see some type of substitution, and also one place where you can see substitution not only against the PICs, but also against the deposits to the banks, where you actually see this sort of ongoing fight. The one reason why they still adopt it is for cross-border finance. Anything that is cross-border finance is something, it's happening as something that is sort of supranational. And so stablecoins actually find a very good fit, even in countries where the transaction costs are much lower.
For the issues that come with reconciliations.
Exactly. And so cash flow management for businesses, even in Brazil, where they have perfectly fine options, might find a perfect fit for stablecoins. And that's actually what is happening right now.
I'm going to open it up now to the general panel. Few questions, because we actually spent a long time on just the introductory ones. I can see the VARA folks at the back wondering when we're getting to it. Apologize. So this is up for everyone, but I'd particularly like to hear from Dimitrios and Peter on this. We've got, I mean, just now we've all witnessed disagreements on how these things should be regulated. We've got one view that has been put out, which is separating out fiat reference, asset reference, and so on. We've got a second view over here where there's disagreements. We've got digital payment token regime in Singapore. We've got the payment token regime in the central bank here in UAE. We've got the MiCA systems coming out. We've got all these different varying regulatory regimes. From a regulator's perspective, and I will request, I will have to cut you off, otherwise we won't get to anything else, because I know you do this for a living. Is there any potential for harmonization to create a viable strategy for businesses to actually operate globally? Otherwise, it kind of defeats the point of having these kinds of assets.
So I'd say first, in terms of companies kind of looking to operate, as countries are developing their national frameworks, particularly if you want to operate in an advanced economy, you can look to the international standards. They're already agreed. The FSB has standards. IOSCO has standards. BCB has CB. There's lots of international standards that all these countries have agreed to. You can look at the frameworks that they're going to be implementing. They might change a little bit, based on the legal frameworks, but the fundamentals are there. The principles are there. They're not going to change that much when they get to a national level. I think the question around kind of a single global rule book, that's just legally not possible. There's no legal framework in the world to make that work. That's why we try to have international standards where countries come to the table, we agree on the principles, and then they go back and implement.
Maybe not a single rule book, but some kind of passporting, which is certainly more realizable.
That's a bigger challenge. You need to have.
That requires you to talk to other people.
So those exist in many jurisdictions around banking. You can have branch offices, things like that, but you need a very developed regulatory framework where supervisors can talk to each other. They understand the regulations in the other countries. It's just too early, I think, for crypto.
Well, I agree 200% with what the colleague of FSB mentioned. First of all, it's very important for the industry to have some kind of global regulatory certainty, especially if you are a company like Circle, that you need to operate in 150 different countries. But what this company should ask, is it harmonization the correct word? I remember when we introduced MiCA,
I can tell you all the companies agree harmonization would be super helpful.
Yeah, true. Yeah, you're absolutely right.
Smiling over there.
What I want to say, though, is that during the negotiations of MiCA, we had a very painful conversation regarding putting in place, how we call it? Equivalence, yes. The equivalence regime. And the equivalence regime was immediately rejected for two reasons. First, we didn't want UK to be benefited in any way from this process. And second, after 3 years out of the European Parliament, I can speak.
I left 10 years ago, I get it.
So this is the number one. And the second, when you have equivalence measures that ensure some sort of harmonization, you need to review it every 3, 4, 5 years. And this is a very painful process. And if you don't have the personnel to do it, and you have 25,000 other files to work, it's very difficult. What we can achieve, though, harmonization is super difficult, common rule book, impossible. What we can have, though, is what I try to call enhanced coordination. agree on the basic principles, and agreeing on the principles is one thing. Agreeing also on the supervision and the enforcement. This is the most difficult thing, but also the most useful in order to ensure some legal clarity globally. Harmonization, not necessary, but enhanced coordination, it's something we should do. What do you think?
Yeah, maybe if I can just add a couple of thoughts from an operational company perspective. I mean, a stablecoin is inherently internet native global asset, right? So if we end up fragmenting the liquidity, the accessibility, interoperability, depending on the jurisdiction, then the entire thing really doesn't make any sense anymore. So we will need some form of global usage that is still compliant and regulated. And then there's different ways. I agree, probably one global framework, we'll never see it. Then there's the middle way, equivalence, maybe recognition, some form. I think we might get there between some jurisdictions. Say, if your euro is a regulated e-money token in the EU, we as whatever, the UAE, US, recognize that you can distribute it here locally. I think we will get there.
And other markets achieved it through the years. I mean, after 20
exactly.
years, we will go there.
Exactly. We're seeing that in other markets, right? And then maybe the least, and I would say the easiest form of global usage is when jurisdictions don't necessarily think about their issuance framework only for a regulated stablecoin, but also the distribution. Because it doesn't make sense for a globally operating company like Circle, for example, to issue our stablecoin in like dozens of jurisdictions. Because issuance means that you issue it under a certain legal framework, and that brings complexity on the legal front, on the operational front, etc. However, we want to distribute our stablecoin either directly or indirectly through partners in as many places as possible. And so what we're currently seeing is that some jurisdictions, I think Japan, the UK is also thinking about it, is like next to the issuance framework for local currencies or for global currencies, regulators also start thinking about what mechanisms and measures can we put in place for global companies to distribute it either directly or indirectly.
Fantastic. So to Vineet and Marco, a lot of the founders, I'll speak from personal experience that we end up speaking to, that are doing anything today that's seemingly interesting in crypto. It usually starts with, we just want to let you know we're not regulated because we're DeFi. Yes, that comes up a lot. And then, by the way, we're also using a stablecoin on our platform. For no reason, we just think it'll help move things along faster. And we're going to build our own stablecoin for that. But that's neither here nor there. Mostly, we're unregulated. So from your perspective, given the sort of increased focus, DeFi infrastructure solutions around it, and sort of the emphasis that's placed a lot within Web3 on DeFi, how do things like stablecoins, which are getting increasingly regulated, and security tokens, which have to be regulated because they interact with the real world, how does that interplay with the world of DeFi protocols, DeFi projects, and people trying to work on-chain exclusively?
So I have a very controversial view on regulation. First, I'll start with that. I try to be
Careful.
Yeah, I'll be as politically correct because this is not a crypto conference. In a crypto conference, I'm too much fun. So, people 2 years back, media asked me when, now that FTX has happened and this has happened, when is regulation coming? I said nothing for the next 10 years. Broad, complete regulation, nothing till 2030. They're like, no, but they are talking about regulation right now. I said, markets are regulated only when something big happens. Someone climbs that, terrace and jumps off from there. India had 2 stock market crashes, the Harshad Mehta scam and the Ketan Parekh scam. People actually died. And regulations had to come because market was growing quite big. What happened in the last FTX crash? Nothing. Did you hear about anything like that? So the problem is regulation always comes once masses come behind it. Till now, I don't think there are only 400 million people in crypto, which is 4% of the world population. 90% are speculators. So that's why it's highly unregulated. But when it comes to things like DeFi, $9 billion on our way, I think 9 or something like that, which is nothing. So yes, slowly, regulation will come once mass adoption comes. We need to have a lot more money coming in. They say about ETFs being regulated. Yes, there is money coming in from there. So as we go along, regulation will come, but the market will become very stable.
But ETFs are so tangentially related to what Web3 actually is.
It's actually not required. You know,
At all.
Bitcoin was created because you would own your own money. Now you're giving it to someone to own your own money. So it's the same thing, right?
It defeats the point.
Yeah. So what I'm trying to say is that regulation will come slowly, slowly. Again, the markets are evolving. It's like the 1980 stock market of India, you know. It was all done on hype, on rumors. But today, when 20% of the world Indian population is in there, it's all regulated.
Hype, rumors, sentiment.
Everything.
Another word that gets thrown around a lot
It
in
is
crypto.
the wild, wild west. Crypto is the wild, wild west. Where in the world do you get a 20x or a 100x in real world? Nowhere. And that's what crypto is right now.
For now.
Okay, so let me try to launch a couple of grenades. So, so one potentially is I totally agree with the idea that we are sort of in a transition phase. I disagree with the point that all founders are like that. I think there is a little bit of a premium to founders. The sort of
Most founders are like
that show up and saying, you know what, we actually want to be compliant because we want to be above the rules. But there is still, I think, a push for many of the, especially the layers one, to start with, okay, where do we start building use cases? We start with the usual DeFi use cases, okay? But I think at this point in this transition phase, if you think about it, we are having a lot of confluence of interest from different points. Institutional investors are coming in, which is great, but at the same point is sort of against the whole Satoshi vision, right? So we are sort of just giving back money to the Larry Fink of the world. Fine. The regulators are, I think I am on the side of saying that they are waking up to this, just because if BlackRock says jump, every regulator will jump. But then there is also the issue that, well, all the players right now, those are going to be the winners 5 years, 10 years from now. And so that's one gradate. Do we believe that USDC or USDT are going to bring the one winner take it all market?
For the sake of this panel, yes, yes, for at least one of them.
I mean, one vision, right? One vision that technology sort of teaches us is that the ones that does all the hard work with the regulator doesn't mean that it's going to be the one that wins at the end. Right, so in some sense, we might thank you guys for going talking with the French regulators and European regulators, trying to battle against the Treasury Department in the US. But then at some point, there is going to be the opportunity for everybody else to get into the market in a market that is that has boundaries that now they don't exist. You just make it easier for everybody else to actually come in and not being blocked by the regulator. So I think the next 5 years are going to be super interesting, even in the boring market of the stable coins. You know, if you think about it, right now, that's the second grenade, just because I want Patrick to talk more. If you think about it, you know, Circle is going to go probably through an IPO. Why? Because now they can show that they are making revenues because the Treasury is giving you 4 or 5% yields.
Circle has been an IPO since it launched a token.
But now is the time. What happens after they do this? They really go into a stage where there is full transparency and they have quarterly meetings with investors where they have to actually answer to. What happens to the rest of the market? Is there going to be another sense where, oh shoot, this is the guys that are abiding to the rules, like the Coinbase of the world? Do they see them more or less afflicted by the regulator? At least in the US, I see them more afflicted by the regulators, right? In some sense, so far, we have seen the regulators going after the ones that ask for permission rather than the ones for forgiveness, which sort of sucks in this market, right? You would like to help the ones that went through this whole process rather than fostering this dialogue with the regulator. So I wouldn't let Patrick answer this.
Patrick, please make it quick because I've been told we need to wrap up.
Okay,
We're having too much fun.
Okay, no, I appreciate the grenades. Finally, a little bit of opposition and controversy. Although I must say, I don't disagree that much, to be frank. I think the market is super early. I think only the market will tell what ultimately will end up succeeding, obviously, in, let's say, 10, 15 years. Our conviction is that if you think long-term, a stablecoin as an instrument class, like a money-like asset class, is so intrinsically linked to the traditional financial system due to its infrastructure, the backing, but also due to just its nature of just being another form of fiat money at the end of the day, that the only way to succeed long-term, whatever happens in, let's say, in the next 12 months or so, is to go that like regulation-first path, to connect very closely to traditional financial institutions, to try to be as transparent as possible, to do everything that needs to be done. If we need to be a trailblazer, as Marco mentioned, in the EU and the guinea pig, happy to do it. It is
Trailblazer sounds nice. I'll take that one.
whatever works best. But yeah, I mean, ultimately, we'll see. What I can highlight is that competition is great. I think it also kind of supports and underscores that there is a very good business case behind that idea of issuing a stablecoin. But what I personally think is that while in the next probably 6 to 12 months we see stablecoin projects being launched across the board, like every single CASP and bank is doing it. Let's wait for the headlines in 2 or 3 years. That's my personal conviction, because it's really tough. And I'm not necessarily talking here about the regulation part or the product and infrastructure part, which is very tough. But a stablecoin ultimately is a network effect game.
All right, we'll close with Vineet having his last comment.
Just a quick bomb from my side. Out of the audience, how many have used a stablecoin ever, not to trade, not to buy Bitcoin, ever for a real world transaction? Okay, that's like 8% in a learned conference.
Ask the same question about Bitcoin.
See, again, 4 years back, I would. So what I'm saying is, see,
Nobody's paying with Bitcoin. We're holding it.
Please imagine 4% population. How will regulators regulate this, or will they go towards the stock markets, which are done by 20%?
Well, I mean, central bank regulated it. They just put out a rule and said, if we find out you're accepting it after June 2025, we'll shut down your business.
We're very early still.
Well, no, they launched an AED stablecoin, got in principle approval 2 days ago. So here we are. Okay, I will close out with one question, and I think this is going to be the most challenging requirement for all of you. So please prepare yourself. In one sentence only, and not a run-on sentence, how would you define the future of stablecoins and security tokens?
Is going to be bigger than any other crypto asset ever.
Patrick?
You need more time?
I need more time to think. Go for it.
Okay, I think for the security tokenization, what we observe is that it's going to be developed more on dump liabilities part, so not information sensitive aspects. And because it's an information technology, it's going to accelerate pooling structures. We had already indexes and ETFs.
One sentence.
Full stop.
So I'll be quick. Regulation is coming, but be patient.
Marco. I think it's going to be in the middle of the investment return curve. We started with cryptocurrency, high investment, high risk. We went to treasuries with Franklin Templeton, Ondo, and BlackRock, so low risk, low return. I think the future is sort of in the middle, where really the liquidity needs are going to be and where tokenization may actually play a big role of benefits there.
Yeah, I was about to cut you off. Well done.
So, all right. So let me just say, I think stablecoins will be treated as a protocol for money in a couple of years.
So, all right, we'll take one question from the audience. 2 questions from the audience.
Hi. So basically, we were like, before Bretton Woods was gold-backed currencies, so kind of like in gold we trust, and then after Bretton Woods we got like in gold we trust. So we removed the L part. Okay. Now, do you see the future of commodity stablecoins? How much from 1 to 10 across the panel?
They are happening, but I think
Adoption, sorry, not
adoption?
not the creation. Yeah, of course they are, but adoption, like real, from 1 to 10.
Still a niche, I would say 4.
Okay.
2.
I think still a niche, but it can lead to a very stable coin. There is a coin being done by Nouriel Roubani, the Dr. Doom, which basically mixes US Treasury rates, gold, to make something which is real stable. So it will happen someday.
Then from 1 to 10?
5.
Okay.
3 in developed economies, 7 in less developed economies.
I would say for now, tiny traction. We don't see a lot of demand, so maybe 2 or 3. Operationally more complex than fiat-backed stablecoins, also when you think about redemption, for example.
Thank you. Okay. Thank you, guys.
Hello? Perfect. Quick question. First of all, thank you for this enriching discussion. Thank you for the participation. Quick question. From a regulatory standpoint, what do you think should be the definitive factor to classify a crypto asset as a stablecoin? The purpose to maintain a stable value or the underlying asset? And for that, imagine, for example, a crypto asset that has an underlying asset like Venezuelan Bolivar, for example, that is not a stable fiat currency, but it's a fiat currency. You know, it's a question for the panel, whoever wants to.
In less than half sentence, it's always a problem to decide if we put first liquidity or value. My feeling is value. However, market will advance liquidity.
I think you need both. I don't think you can completely unlink the two. If I think about just practical examples, if I launch a stablecoin, I say that's like linked to the dollar, whatever. But then in reality, I can do whatever I want in terms of backing and actual assets and value. I don't think that will work. And the other way around, it's also difficult. I'm just trying to think of examples. I have gold in my reserve, but I say my stablecoin is pegged to whatever, like wheat. It sounds both operationally and regulatorily wise, complex and not something we should strive for.
I guess I would say that the purpose matters, but I think the market will drive the other parts, which is, look at the market today, 99% of stablecoins are tied to the US dollar. There's a reason for that.
Can I just say, for a stablecoin pegged to a currency that's already very unpopular, we won't name any. You can launch it because you can launch anything you want. Will it succeed? I wonder why. And as far as basing it on a basket of assets and algorithmically placing it but calling it stable, we already saw what happened with Terra Luna. A lot of these folks got activated in what they're doing right now in response to that. And so these sorts of examples have created a need to make sure the value actually exists, the liquidity actually exists. If you're going to sell it to normal people, particularly in the developing world, who are taking aside what is their monthly income of $10 and $15 and putting it aside in the stable value to try and make it inflation-proof for a little bit, that's a certain kind of responsibility that frankly should be regulated in my view.
One more and then we're good.
My question is mostly directed to Peter because he brought out the magic word. He said that a stable coin is a promise to track an asset. Now, a promise is an element of a contract. Earlier today, we heard that contracts underline all transactions, approximately. Mm-hmm. My question is, why are regulators so shy of contracts? Why don't they go out to the world, the stablecoin world specifically, and say, where's your contract? Well, specifically, to put a point on it, show me your contract on the blockchain. We know how to do this. We know how to put a contract onto a blockchain. Mm-hmm. But it seems the entire industry is shy of contracts, and not only that, the regulators follow the industry. Why are you not putting the finger down and saying, show me the contract?
So I guess putting aside the question of where the contract exists, because in our recommendations we're technology neutral, we don't care where it is, but we do very specifically call out stablecoin issuers need to have a robust redemption. The users need to have a robust redemption rights. They need to have a legal claim on the issuer or the asset. So we do specify the type of claim the user needs to have, and that needs to be a strong legal claim. So our recommendations are high level, so it's gonna differ in each country how that legal claim looks like. But from when we meet in the FSB and we have over 50 different authorities from around the world, I would say redemption rights is one of the most important issues that we talk about the most in terms of stablecoins, and making sure we get that right and making sure that it's very strong to support the stable value of the stable coin. I mean, we don't get into the technical details of what a contract looks like because that, I mean, at our level, that's just too detailed.
They're perpetually understaffed and underfunded. How are they supposed to have people to create the policy, understand the complexity of financial markets, enforce against the people being supervised, and have a really rarely talented technical team that can look at smart contracts in that level of detail? It's not that they don't want to do it. It's just a matter of, it's just not fiscally possible because the best developers are the ones applying to them, not working for them.